Welcome back to Your Next, the podcast where we explore the journey beyond success, helping founders, executives, and leaders find fulfillment after major life and business transitions. I'm your host, Jerome. Today's episode is a little different and very special. I was recently invited to speak with a private mastermind group made up of real estate investors and corporate leaders, many of whom are standing right at the edge of a major decision. Should they leave the stability of their W-2 job to pursue the freedom they've been building towards in entrepreneurship? In this conversation, we talk about the reality of exits, not just financially, but emotionally and psychologically. We cover why most people overestimate what it takes to leave, how to avoid being a casualty of the founder's exit paradox, and why money alone won't bring fulfillment. We also dive deep into the hard truths of building cash flow, entrepreneurship, legacy, and impact. If you've ever wondered what it really takes to create your next chapter and how to do it without falling into the common traps, you're going to want to lean into this episode. Let's jump right in.
Who we are, what we're up to, and perhaps as today's discussion is going to be about exits. For most of us, that's exiting out of the W-2, and a few of us have done that or are on the way, or maybe that's not even the plan. So maybe at the last 30 seconds of your introduction, give a little bit of piece of where you are. Jerome, can you hear us all?
Yeah, it's great, man. Good to be here with you guys. Thanks for having me.
I love it. I love the depth of your podcast room on. All right, I'll kick off first. Like I mentioned, we do this a little bit about the background of us. This group probably had its origins about 4 or 5 years ago during COVID time. Geez, exactly probably 5 years ago, around this time. A lot of us connected in virtual meetups. And then we started out really grassroots, like, hey, let's meet up on Sunday nights and underwrite together, look at deals together. And then eventually that grew to working together, partnering, and then putting together a weekly forum where we could talk about everything, not just multifamily. It grew to growing business. You just heard two guys chatting about crypto and whatever it may be. Although we all have the common thread that we are multifamily investors. That's where we're taking it from here. So let me go first, and then I'll have everybody just give a quick 1-minute intro to themselves. Me, I'm the passive investor, multifamily investor, now probably about 4 years of doing that. I also, in terms of my game plan has been building out a 5-year and 10-year plan. The 5-year plan still involves my W-2, but eventually want to have that idea of what I'm going to do when I finally walk away from the corporate world. So that's why I think what I'm looking to get out is just listen to, the mindset, like what needs to be, where do you need to put your mind and how do you want to think about this? So that's myself. I guess whoever wants to jump in next.
Yeah, let me go, Jerry. So Miguel Rodriguez, I also, Jerry, have a W-2. Honestly, interesting enough, I work for the federal government. So my life's kind of been turned upside down, and I'm really excited about whatever the opportunities are that are going to come out of all this wild stuff that's happening. Been involved in multifamily syndication for many years now. I think currently developing something in the city of Newark. I'm in New Jersey. We're looking to do syndication in Columbus. Those are our 2 target areas, Northwest New Jersey, and just still in the game, trying to buy more properties and just figure out a way to exit the W-2 and do this full time. I'll flip it over to whoever's next.
Yeah, sure. Hey, Jerome, Alex Turner here. I'm a real estate investor full time. I have side businesses that I'm working on recently, new projects starting, but I've been investing in residential multifamily space and actively investing, not passively, trying to stay focused. No W-2. I've been out of W-2 for the last 6 years, probably, right around year before COVID. And I've been focused on that.
Yeah, Mark Weissy. I started off investing in 2016 or 17 kind of time frame here in North Jersey as well, along with a lot of the same other guys. Scaled up to multifamily, all really out of state in the Midwest. And then more recently, in the last year and a half, got into hospitality, ground up hospitality, and a hotel in Puerto Rico, which is taking up my time now. And as far as the W-2 journey, a couple months out from pulling the trigger and firing myself from my jobs.
That's great. All right, Lloyd.
Hey, Jerome. Thanks for speaking to us today. I'm Lloyd Priest. I work full time in Manhattan in a W-2 job in finance and technology and sales. I've been investing in real estate for the last 4 years now. Currently got 6, 7 properties under my belt across a mix of single family and multifamily. Also invest passively in deals. I've been working on a similar to Jared, 5, 10, and 15-year plan from when I started to exiting, and always trying to consistently strategize on how I can speed that up. But yeah, excited to hear you talk to us today.
Yeah, I've been working W-2 a long time. I work for a fix and flip company doing fix and flips nationwide. I've owned a number of rentals in multiple states myself, sold off a bunch in 2022 and 23, involved in a couple passive multifamily syndications as well. And yeah, I'm excited still listening today. I have a young family, been a W-2 a long time. So I have a tough time seeing that far ahead, being able to exit. Yeah, looking forward to listen.
Thank you, Jared. Greg?
Yeah. Hey, Jerome. Nice to meet you here. Yeah, I actually remember listening to some of your talks. You would be out walking and you do your podcast or whatever. I do recall a couple of those, but yeah, I'm a multifamily investor passively for the most part. I do have a couple of properties to my own name, a couple of units, actually in the process of buying another 2 unit as well. I'm in the W-2. I'm probably a few years off. I think my multifamily is really, over the last couple of years, the distributions have slowed and it's been a little slower than I would have liked, which I'm sure everybody's familiar with. But yeah, I guess I'm excited to hear about what you're going to talk about. I do have the restricted shares of stock, the things that keep you attached to the job. And some of those things I think are definitely sometimes hard to walk away from, I think.
Thanks, Greg. Next is Amit.
Hey, Jerome, I'm a full-time investor, real estate investor. I quit my job about 3.5 years ago, going on my fourth right now. It's been a crazy journey for me. I would say successful for the most part. Right now, I'm focusing on shifting my business from buying, holding to flipping properties in San Diego, but I still focus on purchasing more properties. And I really missed my W-2 job. I don't. I'm so happy I got out there. We're looking forward to listening to you guys and see what's going on.
Thanks, Greg. All right, Dan, you're up.
Hi, Jerome. Dan Protas. Do have a W-2 job ever since graduate college, but investing in real estate since 2017 and made a switch to commercial multifamily last year. Looking to do syndications and definitely hearing you and talk about the mindset exiting W-2. Very interesting topic.
And I think Randy, you're up.
Welcome, Jerome, to our group. Thanks for presenting. I'm a W-2, work for a bank. Tell me about it, how to quit. The opportunity cost is there. The comfortable feeling is there, but then desire is there to be financially independent, but not there yet. Happy to listen. Thank you.
I think that's all. That's us. Oh, thank you. So
Real legacy investment. Who's that?
Miguel, he went up first, right,
Okay.
Miguel?
Okay. I thought it said Miguel and then it changed, or maybe it didn't change, but okay, I'm with it. Okay. Yeah, that's everybody. Taking notes, baby. We're ready.
I was just going to say, that's a great observation. That was me going from phone to the computer here. That's pretty good.
So Jerry, how do we want to do it? Do you just want to do Q&A? Do you want me to go? Because I can go for 3 hours if you guys want me to go for 3 hours. You tell me what's best.
I like the Q&A. I would say give us maybe just a few minutes about your journey. I know even
Yeah.
from for everybody's benefit, I connected with Jerome about 4 years ago. He had a cohort. Some of the things I learned and things you said, Jerome, were still, I remember. A lot of us have the commonality that we also connected for multifamily. You were always different, and you were more of the route of joint ventures, getting equity. Yeah. I remember a lot of that. And then I guess kind of your story also having left corporate yourself.
Yeah. So before we go to my story, I'll tell you, I probably did it the wrong way. You guys are doing it a much wiser way than what I did. I think the economy is pretty tough right now. So if you have a job, I think that income is really valuable. I'm seeing a lot of people who thought they were full-time real estate investors or syndicators or capital raisers or whatever you want to call it, trying to find jobs right now. And it's just really difficult if you spent the last 3 to 5 years raising money for real estate or doing deals that failed to get somebody to hire you. And there were some people who jumped out early, didn't have success, and now they have to tuck their tail and go back in. It's my belief that if you're going to leave, you should leave and never go back. And so when Ahmed was talking about, hey, I don't miss my job, the worst thing I think a person, that's probably not the worst thing, but it's tough, is to leave thinking you're never going back and then find yourself back in a couple of years. There's a lot of people who bought things they shouldn't have bought. And I think pretty much everybody here has been interested in real estate, and you probably see that as a way to finding your exit. I don't have an idea of invested capital that you guys have, but I know most of you are making six figures, mid six figures. And so the amount of capital that you have to push into real estate in order to replace that in your passive income is going to be significant. And if you just think cash on cash return, if you need to replace $250,000 of income, you need $2.5 million in real estate. And that's the assumption that you're getting 10% cash on cash, which from my perspective doesn't exist in a syndication today. So if you're trying to grow that portfolio, your cash flow is your dollar is going to buy less cash flow right now. And where I see and where we've done really well in our deals is on the exit. We've appreciated very well on all of our deals. All of our deals had 3 and 4 equity multiples, and we're really happy about the performance of our deals. That is a whole nother piece of the conversation. So what I will say, if you haven't figured this out, is know what your number is, right? What is your exit number? And whether you want to do that on an annual basis or a monthly basis, what do you need? What do you actually need? And if you're trying to replace it with passive income, most people don't know what that number is. One of the things that we did when Jerry was going through our multifamily course was we said, what's your number? What's your passive income number? What's your freedom number is what we called it. And so does everybody know what their number is? That's talking about leaving their W-2? Is there anybody that doesn't know? Is probably a better question. Can you raise your hand just so I can see that I'm okay? Okay, Greg, Miguel, like you got, okay. And then I want to make sure I say it, Randeep, make sure that you know what it costs to run your home, because that's what we're trying to get to. And if it's only $5,000, then you only need $5,000 a month of income. And so $60,000 will get you there. Something less than you might be able to get out for $500,000 if you got the right savings. And this kind of leads me into my story. I built a $20 million division for a Fortune 550 company. I got to the end of the year, and on December 24th, my guy called and said, hey, we're going to lay half the team off. And I was like, we're not going to do that. And it's 4:55 on December 24th. We go back and forth for a while, and then he hangs up on me and says, I'll see you in the new year. And so I spent the time between Christmas and New Year's figuring out who was going to stay and who was going to go. And I promised myself I would never do that again, especially not if somebody else told me that I had to do it. And so the next year, we were going through the same thing. Now, mind you, we had 30% profits, right? So we did 20 million, we had $6 million in profit, and I'm figuring out who's going to get fired between Christmas and New Year's. This is just the most insane thing I thought. And so next year we go through it. Instead of it being Christmas, it's a couple of days before Thanksgiving, and I'm having the same conversation. And in order to keep my integrity, I said I'm out. And so I walked out of corporate America. I didn't have a deal. I didn't even know how to buy a deal. I didn't have any clients. I thought I might be able to consult. Like, I didn't know what I was doing. I just knew I was leaving. And so in my wise old age, I was like, I got savings. I'm good for a year. Being good for a year and being able to invest in something that's capital intensive like real estate, those two don't go together. And then my thought of, I'm gonna buy apartments didn't work either. So I ended up fixing and flipping. Had some success flipping and flipping, but the lumpy income was very painful for me. And so I'm paying out, I'm getting scared, and I'm hoping that I can get to a close. And I'll never forget, I was supposed to close right before my birthday. We leave to go on the trip for my birthday, and I get a phone call from the attorney that says, hey, somebody put a lien on your property for everything that you think you're making in profit. And it was a contractor who didn't do what they were supposed to do. They didn't get paid, and so they tried to tie up the transaction. And so, like, I literally didn't close. I'm out of the country, and I'm trying to figure out how I'm going to get back to some cash because I needed that money to come back in because it was 6 figures. And so eventually we got through the deal. He didn't get paid. I got my money. It worked out. But that was when I really began to understand the true impact of the buck stopping with you as a founder. And it was terrifying because I didn't know how I was going to get from one place to the next. And so a lot of people romanticize entrepreneurship. They'll tell you, like, oh, you got control over your schedule. You do until you don't. And for me, that is the thing that I think most people miss. Like, we came up with this model. We call it 8X's of a founder. And I'll show this real quick, and I promise I'll get back to the Q&A. But like, this for me, it was the roadmap. Like, when I figured this out, everything changed. It was like the veil was moved. And so the first exit is leaving corporate America or being an employee, whatever you call that. And so it's uncomfortable. You're figuring out there's no systems, but you become chief everything officer. Right? If the paper is going to get put in the printer, you put it there. If the trash is getting taken out, you took the trash out. If the marketing email goes out, you did that. You're doing all the investor calls or talking to all the potential clients. You're looking for the deals. You're creating the products. Like, you're doing everything. And so we don't call it chief executive officer at that point because you don't even have a admin. And most people, when they go into entrepreneurship, like, they feel like they go from making money. And so let's say you make 250. You're making 250 right now, and you go into entrepreneurship. And if you don't have any clients, you go to zero. And you go to zero until you have a client or you have a deal that's paying. And you might not have a deal that's paying if you don't have any investors. And I just think most people don't actually understand how hard it is to go from 0 to 1. Having that proof of concept before you exit is a complete and total game changer from a confidence standpoint. Because if you do it once, you can do it again. Now, how long and how hard it takes to go from 0 to 1 compared to 1 to 2, like, it gets significantly easier, but it's still tough. What we teach people when they're exiting is you want to do it 10 times. And once you've done it 10 times, you truly have what we consider to be product market fit. You know what the objections are. You know what the challenges are. You've got enough experience doing the thing that you know where you're going to mess up, where the mistakes are, and how you get in trouble. I'm only going to talk about the first half of this today because it's probably only what's relevant to you guys. And so once you become chief everything officer, then after you leave that, you want to become a thought leader. That in and of itself gets attention to what you're doing. And so if I apply this against my model, was it Chris? Who was it? I think it was Greg. It was either Greg or Garrett talking about the videos, right? The walking videos. And that was me building a presence online. That was me getting attention to what we had going on. And even if I never did anything with the person, they had something to remember me by. And the thing that I think most people struggle with, as an employee, you can be completely invisible. You can only talk to the people that you absolutely need to talk to get something done. The number of people who need to know who you are and what your company does is exponentially greater than the number of people that you'll ever do business with. And so if you haven't figured out how to, and I'll never forget, I'm sitting in the front of Dave Lindahl's mastermind on a chair. And he looks at me and he says, Jerome, if you don't figure out digital marketing, you're going to go out of business. And I'm like, okay, thanks for bringing me here to tell me that, because he didn't have a solution for digital marketing. You got to figure that out. And so if you haven't figured out like how to get attention online, and the attention that's going to let people see that you're good at what you're doing, you're probably missing out on the highest leverage activity that you can create. And the biggest mistake I made in my transition from an employee to a founder was trying to build a faceless brand like Nike. Founders, especially if you're doing investments, have to be seen. They want to be able to watch you. In my case, people watch for 6 to 9 months. They want to be able to go find you with their independent search online. And then, depending on what's happening, they want to do a background check on you. And so the anonymity, being the anonymous rich guy, I don't know where that exists. And if that's what you're hoping for or looking for, just know it's going to be friction on your path to success. And it doesn't mean that you can't do it, but I just want you to do it as efficiently as possible. And you are introducing a tremendous amount of drag. Now, the struggle that I see more often than not is I can't talk about that because I got a W-2 and I'm not able to do the side thing. I don't know what to tell you. But what I do know is if you don't build a group, and I mean, if you don't build a following and then you are turning off the income from the W-2, you are going to be at zero. And the following is a 1 to 5 year process to build something of significance. From my experience, the only person that I've seen go faster than that is Maurice Philogene, but he was already rich before he started. But I remember when Mo had 3,500 followers and now he's got like 65,000. But he doesn't have 65,000 as an investor. His trajectory changed as he was talking about lifestyle design and travel hacking. And he literally went from like 10,000 to 35,000 in 6 months. And then there was another 30,000 over the next 6 months. But before that, I mean, he was 3,000, 2,000 people following him. And so for many of the people that I consider to be influencers or folks who built followings in the started pre-COVID and then grew through COVID phase, that's the only one that I've seen that's really gone hyperbolic. This is probably the best way I can describe that. So I'll stop there and we can go wherever you guys want to go.
I have a question, Jerome. For the intents and purposes of this group, we're obviously all quite focused on real estate, and a lot of people in W-2 trying to figure out a way to continue to build that passive income to one day kind of replace the active. When you think about people who've done that successfully, how do you differentiate those who are in that path to migrate over from active to passive? What are they doing that maybe the ones who aren't successful in that process don't think about or don't do?
So I think the first thing is the number that most people come up with the first go around as their freedom number isn't the right number. It's too high. So the first thing you need to be able to do is pay your bills. Right? Most people are trying to figure out how to replace their income. And for folks who are investing, replacing your income means that you're also replacing the extra money that you're saving or investing. To get out, you don't need that. And I say that because for the people, like the thought, and it's almost arrogant, the thought that you can take something that's a side hustle and make more money doing that than you do with your day job. Like, I just find the arrogance in that so great. I'm going to be able to produce more income working part-time in my company than I can working for somebody full-time. It just doesn't compute, especially when you think of the fact that the person that's paying you to work the job is extracting value. Like, you don't get every dollar you create in the job that you're working in. And when I was selling time and consulting, we were multiplying whatever the rate of the person was that they made by at least 3. So for people who think it's going to be a clean transition, there's not going to be any impact to your income, I just don't think that's real. So I think that's the first thing. The second thing I would say is they're not willing. So then this kind of goes, it dovetails into that. They're not willing to sacrifice anything. So if, like, we got 2 Teslas, right? We don't need 2 Teslas. And so if I was trying to get out, I wouldn't have 2 Teslas. I might not even live in the house that I live in, right? And there's certain things that you have to be willing to give up so that you can get that extra 40 or 60 hours that you're giving to somebody else to put into your thing. And then you want the leverage of having other people work for you in your thing so that you can continue to grow it and take advantage of that time. Dan Martell is doing a great job of talking about buying back time. It's just a brilliant approach that I haven't seen anybody do. It's just so well done. And I just find that people don't actually understand what they're willing to give up in order to get to what they think is going to be, I don't want to call it nirvana, but they think they want to be entrepreneurs. I find most people, once they're entrepreneurs, don't actually want to be entrepreneurs. They like the freedom, but the stress of figuring out payroll early on is tough. Or revenue dipping because something that was working stopped working sucks. The responsibility of knowing that, hey, like there's families counting on you once you start hiring employees sucks. Unless you're just a cold-hearted bastard and you don't care about the people who are tethering their lives to the vision that you created. So it's the understanding of the financials, the underestimation of the work that it takes to actually build something of scale, and then the thoughts around the sacrifices that go with it. In general, the strategy is, so people talk about project management all the time. In general, it doesn't matter what you think. It's going to cost more than you think. It's going to take longer than you think. And if you're not willing to go all the way to the end and then past it, you could turn around 3 feet from gold and waste all of the effort that you put into the thing. As far as success, what I've seen is the people who actually make investments in people helping them get to that next level, they get a multiple on that and they reduce the amount of time that they invest in it. If I talk about Dan Hanford and I started investing in multifamily at the same time. He went syndication, I went joint venture, I went Dave Lindahl, but I didn't go through their program. I just joined the mastermind. He hired Joe Fairless for one-on-one coaching. Dan Hanford and PassiveInvesting.com have over $1 billion in assets under management. I don't. But I never wanted to do what they wanted to do. But it's just two different strategies. What I know for a fact, though, is that there's a whole lot of people who said they were going to figure it out on their own. And they did some of the stuff I did, listening to 40 hours of podcasts every week so that I could figure out what everybody was saying. And then try to put that together and create my own strategy instead of an end-to-end system that explained to me what I should expect. Like I did it the most inefficient and ineffective way. And so when I like pull all of that back, the thought, so just because you've been successful at having a job doesn't mean that you understand what it's really going to take to be successful as a founder. And the thought that if I don't invest this money with somebody to guide me through this, it just means that you make mistakes that you could have skipped over. And many times those mistakes can be like mission critical mistakes. And then you end up turning around and going back in. As an example, I've watched people fail on their first deal. When I say fail, like the first deal goes back and they're no longer syndicators, as an example. If you're running an education business, putting something out that doesn't actually deliver the result for the people that pay you is the fastest way for you to have an awful reputation. Your reputation and perception is worth more than pretty much anything else when you're coming out as a founder, mainly because you have to transition the way that people see you. So if you're a fintech guy, and you've always been a fintech guy, and now you're, I don't know, a sponsor for a deal, people struggle with that transition. And if you don't have fast success, or you can point to somebody who's going on that journey with you, not a whole lot of people are going to place that bet. Does that make sense?
Yeah, I guess what I'm hearing is they're coming out with a basic fire number and then a kind of fat fire number. And once you get to your basic number, that's really when you have your element of freedom and you can exit. And I think the mistake a lot of people make, or what I perceive the mistakes term, what a lot of people make is you have this concept of passive income, but there's no reason that you can't have a form of active income when you do make that kind of exit, as long as the active income isn't something that you enjoy. I think that's what most people crave. I don't think anyone here would retire and sit on the beach for the next 12 months. I think everyone here wants to be working, but wants to be working in jobs that they find interesting or roles they find interesting. So I think the concept of getting to your basic number, covering your basic bills, and then taking that leap of faith, that's probably what you're getting at.
Yeah, I would say that the universe is not going to let you just sit on the beach. Like, it's going to find a way to make you be active. I'm not actually, and it's funny because I don't actually believe in passive income. Like, I don't, outside of the people who are in syndications and even as LPs, they're not even getting the good return though. Right? Like, when you go into a deal, the sponsor is holding back 20 to 40% of the equity. And that carry is where the real wealth is built, especially on the exit, if there's appreciation. And so the thought that you would be an LP, and for what it's worth, like, I spend a lot of time with Centa and Decimate millionaires, and like most of them are still active. So if you don't have 25, 50, $100 million invested, I just don't know how that works.
Yes. So Jerome, in terms of how you had a crystal ball and you were starting today, let me reframe that question. In your chart you shared with us, which step was the hardest to get to a place where it could be repeatable to have that cash flow, right? Like, what was the hardest step and the longest for cash flow so that you can live the freedom to be an entrepreneur?
Yeah, so I have always done some consulting or advisory work in addition to whatever we did in the real estate. I spend an hour a month on the real estate at this point. I review the report that the property manager sends and ask questions, even though I'm the sponsor for our deals. And we've just been working together so long, like it just doesn't take much time. And so what I would say is there is going to be an active component to your work. Now, is that 10 hours? Is it 30 hours? Is it 70 hours? That's going to be up to you. But it's my perspective that there's going to be some active component. What we've seen, and I'll get back to how do you get to the passive or the recurring. What I've seen is there's a bunch of people who don't take any money from the investment. They just keep rolling it in. So if you build some type of operating company, let's just assume that real estate isn't the answer right now. It's very difficult to buy a deal because interest rates are so high. Most investors, if they're selling, they're being forced to sell, potentially a distressed deal. The question is it just distress or is it a falling knife? And like you're screwed from the point where you buy it. The debt that you get, can it actually work? For me, I just don't see many deals working right now. And people were talking about that through COVID. I think it's only gotten worse. And so all of that said, what is the other thing that you would do? You've got a lot of skills. You've got a network. So if there was another service or if there was some other offering that you have for the marketplace, what would that be? And then can you turn that into some type of product or service that you can get recurring revenue from? And if you had that, in addition to what I consider to be lumpy income, because like we do our deals, we run our deals to exit. The goal is to exit the deal. I don't really care if we put $100,000 into a deal and over the course of the year, I get $10,000 in income. That's not going to make a difference in my life. And I watch so many people get tainted. You need to put $1 million in a deal in order to get $100,000 back. And for a lot of people, they can live off 100,000. I don't know in New York, I don't think you can in New York, but like you got to have a lot of capital out. And so what we used to tell people to do is, okay, so don't take money out of your first 3 deals. So do a deal, let's just say it's 50,000. Put 50 in, flip the 50, that 50 turns into 100. Do another cycle, flip that 50 into 100. Do another cycle, that 100 turns into 200. And then you probably need to do another one so you can get to the 400 or 500 range. Now you actually have meaningful money that's going to send cash flow to you that actually makes sense. And you can buy higher quality cash flow. The majority of people that I know, they bought construction projects. They're going to raise rent $200 to $600 a month, but it doesn't cash flow for the first 2 years. So, and then if you're going to do it out of the cash flow, if you're going to make repairs and renovations out of the cash flow, you're never going to get cash flow out of the deal. And so I just haven't actually seen a proven model. And it's really funny because I was in a room that Dan Hanford put together, and I was like, we were going through a pro forma, and I said, I've not ever seen anybody run a construction project with over 90% occupancy. And so it's my belief on an apartment deal, like you don't really start making cash flow until you're over 90% occupied, economic occupancy. At 80%, the deal will take care of itself, but there's no profit. And then a lot of people are running in the 75-ish range. And that's when you start getting in trouble because you can't take care of your capital expenses if you need something to reinvest into the deal. And so I'm not convinced for most people that you're going to be able to produce enough cash flow in short order from real estate right now. What I do think you can do is sell some type of information, knowledge, expertise, consult in addition to putting money into deals and allowing those deals to mature. You exit them, get the payday, and then roll that back in. When people started doing the self-directed IRAs, the thought was, okay, that cash flow comes to me. It doesn't. But when you think about retirement savings, you don't ever take any of the money out, right? Like you just continue to grow it. And for a lot of people, they're trying to get to $1 million, $3 million, $5 million, whatever the number is, but they're spending 30 years to get to that. And the promises of syndication outside of the acquisition fees has been that you can do that in 3 to 5 years. If you listen to Michael Blank, that's his promise to people who buy his $40,000, $50,000 coaching program. I can retire you from your job in 3 to 5 years. The only way that works is if you get acquisition fees, and you have to get 6-figure acquisition fees. But if you can't close a deal, which is something that I started talking about in 2020, if you can't close a deal or you have to do bad deals in order to get the acquisition fee, it's only a matter of time before that catches up with you and you lose investors' money. And now people won't do deals with you. And so now it's, oh, I got the acquisition fees in 23 and 24, but now it's 25 and nobody will do a deal with me. And if you're on LinkedIn, you see the people who vanished, who don't talk about their deals anymore. And that's why. I'm going on a podcast later this week with a guy who literally has had that experience multiple times. So I hate to be negative Nancy, but I just don't see that as the answer right now. There's an active component to your income, even whether it's syndicating and leading your own deals, but you really have to know what you're doing, or selling your expertise in some way, shape, or form, in some type of consulting arrangement or agreement. Mark gave me the head nod. Maybe he doesn't think I'm crazy.
Definitely don't think you're crazy. In fact, that's the route that I'm going as well, is instead of jumping off of the diving board or walking the plank, I'm taking the landing on the trampoline type of analogy, in the sense that going from a full-time W-2 to a part-time consulting role, and then using the rest of my found time, I guess you could say, on real estate. I'm happy to hear that I'm not so crazy.
No, it's so wise. From my perspective, it's so wise. I just watch so many people they get crushed, man. They get crushed. And what do you do? Go ahead, Rudy.
Hey, I'm just picking up on consulting. I know what Mark is doing. Do people really need consultants? And where are those opportunities?
So I don't know your background. The short answer is absolutely. Whether, like, your company probably won't like me saying this, but you're consulting for your company right now. Whatever problem you're solving for that company, you just happen to be on W-2, but you're the expert. And they're paying you well to solve that problem. There's other people with that problem, right? And with the slight tweak, it might be something that a whole lot of people need. Now, be clear, man. Like, I'm an engineer. I'm a civil engineer. Like, nothing that I talk about on a regular basis has anything to do with civil engineering. But with that said, thinking like an engineer is helpful when you're problem solving. I think the other thing I would say is, I mean, I remember one year I spent $300,000 on masterminds and coaching. So I've gotten multiple Ivy League MBAs or whatever you want to call it over the course of being an entrepreneur. I've learned a lot. And I've probably learned more outside of corporate than I did in all of my years in school. And so the ability to acquire skills and knowledge, particularly for the problem. And so what I would say about the consulting thing is this, and this is what we actually teach people when they have their big liquidity event. Your next is about finding the people, your people you have an affinity to, who have a problem that you know how to solve, and creating a process to solve that for them over and over and over again, better than anybody else in the world. Like when you do, that's when you get massively wealthy. And so if you don't know who those people are and you don't know what that problem is, doing that work makes it very easy for you to have clarity about what you're supposed to be doing with the found time. Because back to this beach conversation that we had, I don't believe that we get free to sit on a beach. I think we get free so that we can go do the work that we've been placed on this planet to do. And that mission work is there for us, and we're rewarded with that freedom so that we can go do that mission work. If you think about your life and you think about going from doing all the stuff that you've been doing, all of the achievements, all the accomplishments, to sitting on a beach, golfing, sailing, scuba diving, snorkeling, driving fast cars, trading watches, like you would go mad. If you think about a large breed dog, like they have to move, they have to run. You're not going to be a top performer. You're not going to earn what you earn if you're not great at what you do. And so the thought that you would make money so that you can do nothing, like it sounds cool, but like when you really think about it, think about the last weekend where you just did absolutely nothing. Now imagine doing that for the rest of your life. Like, that gets old really quick. Like we need stimulation. And so what we find when founders have 8, 9, 10-figure exits is if they don't know what's next, they waste away. We call it collateral damage. So they blow up their self-image. They don't have the company anymore. They don't know who they are without the company. The relationships, most of them end up getting divorced. They strain the relationship with their kids, the people that they work with. 3 out of the 5 that they talk to on a regular basis, they don't have an interaction with anymore. They have no idea what to do from a work perspective. Their health is a disaster. They don't.
These are the lottery winners also.
So it's almost the exact same phenomenon, except for there's a real opportunity. The difference between the lottery winner and a founder that exits is that the founder had the opportunity to grow their vessel, right? So you didn't take the salary, you put the money back in. You're growing with the company. You're growing with the value of the company. The lottery winner didn't do anything. They put money on a ticket and then the money came. So there was no opportunity for the vessel to grow, to be able to hold the blessing. The founder, they spend 10, 15, 30. One guy we were talking to last week, he spent 47 years building a thing. Now, he exited for 54 million. Over the course of almost 50 years, that's great. But if you don't have a plan for what to do with it, you've got more time than you've ever had, and you've got more money than you've ever had. And you don't really, whatever problems you had, they only get magnified because you don't have anything to distract you from it. And then the question that everybody asks is, does my life matter? And so your life's never going to matter if you're sitting on a beach.
Yep.
The only way your life ever matters is if you are positively impacting the lives of other people. It's the only way that's ever going to matter. Some people are like, oh, I just do that with my family. Yeah, great. They got lucky, right? They got lucky. But the reality is it's so much bigger than your house. And when you have a real gift, like you're going to impact a wide swath of people, and those people are going to remember you. One of the things that we talk about a lot is who's your six. When I'm doing keynotes or if I am doing workshops for groups, I'll ask them to talk about the 5 people they spend the most time with. And many people say, I don't have 5. Okay, great. So then to pick with them, I'll say, all right, so who are the 6 people who are going to carry your casket? Do you guys know your 6? Does anybody know the 6 people that would carry their casket right now? And that's the point, right? Like, you don't know. You know that you're going to pass away at some point, but you don't know who's going to do that final honor for you. But what if people were fighting over the opportunity to be able to carry your casket because you had such a big impact on their lives? And so part of the reason why I moved away from the focus solely on doing joint ventures in real estate was because I didn't feel like it was having a big enough impact. Like the impact for me wasn't deep enough. It's great that people get a check in the mail. I had a mastermind here at my house today. One of the guys was like, man, you came to my house, you sat at the kitchen table, my kids were there, my wife was there, you wrote me a check. And I'm sitting there and I'm like, I got all this money now and I don't know what to do with it. I hadn't planned for it. That was the moment that I realized that it's never about the money. But he's one of my 6. And I saw him over the weekend and we were talking to somebody that's going to go to our alma mater. And he looked at her and he said to her, it's his goddaughter, he was like, this guy is responsible for my family's financial security if I pass away, because he named me the trustee for his trust. I don't think most people are having conversations like that. But for me, that's impact. There's one guy in the world where he thought enough of me, and he's got a daughter that has special needs, to believe that if he wasn't here, I should be the one making financial decisions for her. And that doesn't happen, from my perspective, buying property. And yes, the property has given me more freedom than I would have gotten any other way, but it's to do the other stuff. And so it's very much a means to the end. Solving the money problem, it seems like the most important thing, but it's a non-event once you actually do it. I don't know if you've ever been in credit card debt, but we were talking about this today. Once you pay the credit card off, like, you don't feel anything. You might feel something that when the next statement comes and it says 0, but you don't feel anything. It's no different, right? Because you're paying the monthly bill, whatever it is. It's, I got to pay the mortgage, or I got to pay this, I got to pay that. Money's like air, though. You only care about the money when it's not there. And so, like, I believe that we live in a world now where, like, the cash is romanticized. Oh, if I got $10 million, then I'm good. But you're not good. You just solve the issues that money can solve. Now you've actually got a real problem because you've got to fulfill and execute against purpose. And I hope that all of you get super rich and then you actually get to the point where you're like, oh, shoot, he was right. Some of you are going to walk away from this and you're not going to believe me. You're going to think, oh, being accredited or being a multi-millionaire or being a centimillionaire, as some of my friends are, is the answer. It doesn't change anything. What changes something is like the impact that you have on other people. That's where meaning comes from. That's where significance comes from, which is the last center of doubt that people struggle with. And so one of the things that I've accepted is money doesn't come in until there's a purpose. And so if the goal is, I just want to get rich, money typically doesn't come in. But I want to get rich so that I can go do this, so that I have my time freedom, so that I can go help these people. It accelerates the process. And I think you get to an outcome that maybe you couldn't even imagine. But it changed from me and mine to the people that I can help with it. So the last thing I'll say, and I'm sorry for going on a very long-winded answer to this question. So 2 weeks ago, I was up in your neck of the woods. For most of you, I was in Glassboro, New Jersey. I have a friend who he and his wife attended Rowan University, and she's on the board of trustees. And so they gave $25 million to open a museum and create a fossil park. And they invited us to the private opening of that event. And so I'm sitting there, I'm talking to him like, hey, what's going on? Like, how'd you pick this? Because we hadn't actually got to the inception story. And the thing that they wanted more than anything, they never had kids. The thing that they wanted more than anything was to create an environment where families could learn and grow together. And so they can stand on this like viewing part of the museum and look down on the fossil park and see families out there digging for dinosaur bones or shells or whatever fossil they might find. And for them, that brings them a great amount of joy because it's something that, you know, had they had kids, they would have been able to do for themselves. But now they've been able to do that. Now, they got a bunch of other stuff to go with that, but that's just a specific example of somebody picking something that's important for them, figuring out how to make it happen. And they have multiple 9-figure exits. 25 million is a reasonable gift for the amount of net worth that they have. And I'm not saying you got to give $25 million away. You can give $25 away. I don't really care what you do. Just think that you have to be a great fiduciary of the time and the money once you actually get it. I see a lot of people hoarding, and I don't actually understand it, but I don't have to. I'm not that guy. Jerry, we're at time. I'm more than willing to go longer if people want to stay on. I know I rambled on. So
No, this has been great. I think a lot of us are going to step back and think of things today for sure. So I always like to be appreciative of everybody's time. So we're at the hour mark. Unless anyone has a dying question they need to go, I want to thank you for coming on. Yeah, no, I think we're good. Jerome, I appreciate it. It was good stuff.
Greg's coming.
Yeah, I just wanted to say great perspective on everything. It's really cool to hear it. So thank you.
My pleasure. Ahmed, you got something?
Just the last thing you mentioned about for the people, you know, that you make the world, that what's important to give back to people. I think there was like a study that talked about happiness. It's not really making the money to make you happy, just being generous and empathy toward others that generates happiness. Ultimately, we want to be rich because we want to be happy. But I know there's a lot of rich people who are not happy and depressed and sick. And this is ultimately not how you want to live your life.
Yeah, so being generous is the answer. My friend, where's this book? So I'll send Jerry the title of the book, but I did a podcast interview with my buddy down in Atlanta, and he did a study, and generosity is the game. Like making the money so that you can give it away to help other people. And it was confirmed by Arthur Brooks. And so like he put the research together with Arthur Brooks he writes for The Atlantic, but he wrote a book with Oprah. I want to say it was 2 years ago. Really good book. Somebody else can ask a question if there's another question. I'm trying to look up this book real quick because it's a great book. It literally changed the way that I saw money. Another really good book is Die with Zero, which really the punchline of that book is give the money that you plan to give to other people while you're still alive so that you can enjoy it with those people. And so this other book is by Dan Crosby. Hold on one second. Let me see.
Hey, Jerome,
The Soul of Wealth. The Soul of Wealth is the name of the book by Dan Crosby. It is phenomenal.
Thank you. Hey, Jerome, while you're searching, or now that you mentioned that, I know you said social was a big part on top of being king of everything. Is there a rule of thumb for how many followers you have equal how many investors and how you're able to have that repeatable?
So the short answer is I've not seen, if I had to answer this question, I would say you've got 1 to 5% of your followers are going to partner with you in some way, shape, or form.
I'm sorry to stretch this out, but I had one question that I definitely wanted to get to. If you're okay with it, it's both Jerry and Jerome.
Yeah, I'm here. I'm here until whenever, guys.
So I've been basically planning for this transition and this is going to be a little bit of a selfish question, so sorry, guys. But I've been planning for my transition for a while now. As a lot of these guys know, it's been 5 to 7 year journey. And I've been very diligent and thoughtful about when is the right time. And still to this day, even being a few months out from making that jump, when I've put all these different guardrails in place, I still have doubts, I guess you could say, which I think is probably natural, is probably a sign that I should do it, if anything. But I'm just curious if those doubts ever subside, or if I should say to hell with it. And I've already made all these preparations and made sure that my jump is going to be as secure as possible and move past those.
Mark, do you have kids?
No.
Okay. You took my arrow out. Anybody who's got kids knows that they weren't ready for kids when the kids got here. And there's no optimal time. It doesn't matter how well it's planned out. Something's not going to go as planned. And so what I would say is what's solvable in your equation is the money part. So how much recurring income do you have? How much do you have in savings? And do you feel like you can stomach it if it all goes to hell and you have no income for 6 months? Are you okay? And then from there is, okay, I don't have any income for 6 months, but I can figure out how to get done what needs to get done. Yeah, you guys are in the Northeast. So my buddy 50 Cent says, get rich or die trying, right? And like the thing that's going to get you through when it gets hard, because it doesn't matter how well you plan, doesn't matter how great your advisors are, there's always going to be something that comes up that blindsides you and you question whether or not you did the right thing. That will never go away. It doesn't matter how rich you get. It doesn't matter how well your business is doing. There's always going to be that stuff. We helped one lady exit her dental practices, and as soon as she exited, she had a mother figure say, hey, I need X amount of dollars. It was like 6 figures to close on a new house. Something happened where she couldn't get to the money that she was planning to use, blah, 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 blah. And before she lent the money, I said, I just want you to know there's going to be an expense that comes up that you didn't expect that's going to be almost exactly the same amount as the money that you deploy to this lady. And less than 45 days, it happened. And she was like, what do I do? I said, what was your agreement with her? And you run down the path and you just find that there's going to be stuff there. At the end of the day, why are you doing it? And do you actually believe so much in the thing that you're getting ready to do that it's the right thing to do? Like all the other stuff aside, is this the right thing to do? And for most people that I know, the point is I can't create a legacy with my job is what it boils down to. And so for those who have kids, they're like, oh, I can't pass this down to my kids. I can't hire my kids into the business, or I can't sell it at some point in order to be able to pass this down to the next generation. For the people that aren't doing that, there's got to be a compelling why. And that compelling why is going to be the thing that pushes you through it when it's most difficult. But if you don't know what that compelling why is, don't do it, because it's going to get hard. Like as soon as you get out, there's going to be something to make you say, and if you don't have somebody to guide you through it, what most people do is they turn around and they go back. Because, oh, it's resistance. I shouldn't be doing this. No, the resistance is the way.
Thank you for that.
I think we can call it a night if everybody's okay. It was really thought-provoking, and appreciate you coming on. Appreciate everybody with the good questions as well.
My pleasure. If we're not connected on LinkedIn, let's connect. If I can do anything, just reach out. A friend of Jerry's, a friend of mine.
I'll send your information out. And Jerome, next time you're in New Jersey, let us know, man.
Yeah, I know we're coming up to see Othello, so I'll let you know when we come up for that. But yeah, that trip was crazy. We got in like late Friday and it was all day. Like we didn't get back to the room till 9, and then we were out at 7 the next morning. So there wasn't a whole lot of space. But yeah, when we got time, for sure. Can't come to your town and I'll let you know we're around.
Thank you, Jerome. Thank you, everybody. Have a good one.